Well, it's the final hurrah of 2022, and the event risk is rolling in. We've seen the US CPI numbers, we've seen the Fed meeting, and next up, we've got the Bank of England, ECB, and Swiss National Bank coming through. Now, markets evolve. Blake and I read the pulse of the financial markets, and we read the room. It's time to get at it. It's the trade-off. Well, hi there. My name's Chris Weston, Head of Research here at Pepperstone, and I'm going to be joined in 2 seconds by Blake Morrow from Forex Analytics. And as always, we're going through the different charts, we're going through the key thematics that are playing through. And what I will say is this is the last show of the year. We'll be back in the new year for more of the same, and we really want to appreciate everyone who's been joining us for the show going forward. But there's a last one that we're looking at, and it's a big show ahead of us today. So if you find yourself liking the programme, smash the like button, subscribe where you can so you don't miss an episode going forward. Blake, I want to bring you into the programme, but before I do, because there's obviously a lot to cover, I want to say happy birthday, 40th birthday to my wife, Patience. I did not miss it today, but I know she's going to be an avid follower, an avid watcher as well. So I want to know that she, from the bottom of her heart, what birthday present means more than getting a shout out on the trade-off. So one there, and Blake, I know you're a fan as well. So say happy birthday to my wife, Patience.
Happy birthday, Patience. Happy 40th. That's awesome. Happy birthday. I hope you have a great day.
Thanks, mate. Anyway, look, we've got a packed show today, Blake. There's obviously a lot been going on. I stayed up early. Well, I was up early to watch the Fed meeting and trade the Fed meeting, and I'm sure that you've been trading that quite actively as well. So I think we want to probably analyse what we've been seeing there, because obviously it does set a stage for the new year going forwards. So let's go into topical thunder, and let's have a look at some of the key thematics playing through on the markets today. All right, Blake, we've seen the Fed meeting. It was an interesting one. We saw some reversals playing through in markets. The initial statement was obviously hawkish. It was hawkish. After the US CPI number that came out, the session that we just seen the prior, the core number at 6%, the terminal pricing for the end of next year had come down, and market expectations were that we were going to see the dot at 4.9%. It came in at 5.1%, so that's why we saw that initial spike up in front-end yields. The US dollar went for that as well. But the Fed also lowered their growth projections to 50 basis points. That was lower than what they were looking for. They've increased their unemployment projections for next year. They're expecting the unemployment rate to tick up about, 90 basis points or so, and they're prepared to tolerate that situation. They've lifted their inflation expectations for next year to 3.5% on core, probably above where the market was looking for. So you're looking at that reaction function playing through. There's no doubt about it that what we saw from those projections was hawkish, and Powell was pretty hawkish in what I've read as well, and what I've seen and what I heard. That he is saying that they're not time to be doing high fives, that the battle has not been won at this point, and the data is going to be dependent going forward. We're open to a 25 basis point hike in the February meeting, but we're not sure. The market saw it as hawkish, but then they reversed. How did you read it, mate? How did you see the situation?
Well, the initial comments that kind of goosed the markets lower was that they expect ongoing hikes are appropriate to get sufficiently restrictive, and then a little bit later on in the presser, he said they're getting close to a sufficiently restrictive stance, and the markets cheered that.
Yeah,
I read it all as pretty hawkish, and I think it was, it's a situation where you're going into this next year knowing that the Fed is going to hold rates at these high levels, I think, and it's interesting to see the market reaction, and I think. What that also says, and if you watch the price action between the CPI yesterday and then the price action in the markets today, we're hovering around that 4,000 level. That really tells us that we have a sufficient ceiling in the market. It's going to be really difficult to get above that, but I can't look past the topic that we've been discussing for the last few weeks here about FOMC and about how the markets are really kind of taking it in. But there's a lot of mixed signals, as far as what the market's giving us, Chris.
I think
we're going to talk about those. Yeah. I'm sorry?
I think we heard mixed signals from Jerome Powell, to be honest. I know he was quite determined to keep rates higher for longer. But did the market buy it? I mean, did they really genuinely say, look, you're onto something here? I think when the Fed are actually calling growth at 50 basis points, it's not much of a cushion, really, to get things wrong. If they get things wrong, the market is already determined. I think this is a really interesting topic, and we'll discuss this further on. The market increased the level of rate cuts for next year in the second half. They actually increased it, despite a more hawkish Fed that said we're going to keep rates higher for longer. The fact that we saw rate cuts being priced in for the second half, what does that tell you very, very quickly, Blake?
Well, it just tells us that the Fed will bend to the market at some point.
I think that's right. I think it sets us up for a very, very lively 2023. The market believes we're going to get rate cuts. The Fed is saying you're not. Someone's going to be right. And I think that's going to be one of the big macro debates we have there.
That is going to be a big macro debate, Chris, and I can't wait to really have that discussion with you at a further at a point in time here in the future. But let's turn the discussion till tomorrow, because tomorrow we got a lot of central banks actually meeting. We have the ECB, we have the Bank of England, and we also even have the Norges Bank tomorrow. We have a few central banks to go before we're done with this mania. Yeah. But I guess the thing is I was talking with our traders and telling them, I think Christine Lagarde and the ECB are going to be talking about, they're looking at what the Fed is doing. And, with Fed Chairman Powell being pretty hawkish today, in my view, does that give the green light for the ECB and Christine Lagarde to also come out of the gate a little bit more hawkish? Now, I know she's not known for that, but she is going to be talking about the balance sheet, and that's going to be a big discussion circling around tomorrow. So, what are your thoughts with the ECB, and especially you got to think about where the euro's teed up at too. The euro has not given up 106. We held very well above 106, and we're near our highs of the. Is it the year? We're near our trend highs. Let's just call it that. And that's something we need to pay attention to. What are your thoughts about the ECB?
I think we're both old enough to remember when the euro was trading at 0.95 earlier in the year, and you see how 106 now. So I think this could be an interesting currency for 2023. They'll raise rates 50 basis points. I know rates are pricing in 54, so there's a very, very small chance of 75. But yeah, we shouldn't be surprised, and there shouldn't be too much move when we get the 50 basis point. What I think is interesting, Blake, is where terminal pricing is at the moment for European ECB settings for next year, and will the commentary from Lagarde marry up with that? So the sort of terminal expectations for the ECB rate is to get to 2.8%. So some way off from where we are expecting a more aggressive ECB in next year. But will the statement suggest that pricing's on the money? I think that we could actually get a terminal price next year up to 3%, but they're pricing in 2.8%. You raised the point of QT, quantitative tightening. It's going to be passive. How determined will they be? How much real context will they give? Now, my personal view is that between March and April, we'll see them reining that balance sheet in, and they might give an opinion that's where they're going to start, and they'll probably rein it in 10 to 15 billion euros per month. But I think how definitive they'll be, how committed they'll be to that is what we're going to be looking at. Where the euro gets a move is in that BTP Bund spread. It's at 192 at the moment. And if we were to see BTP sell off and widen relative to Bunds, then euro could sell off. Of course, they do have the fragmentation tool there as well. But that's what I'm looking at. So, what is the commitment to raise rates to where market prices on terminal at 2.8%, and then how committed are they to that QT and how definitive they can be? So that's where it is. But I think the euro is looking pretty good at the moment, right?
It is, but one of your colleagues, Michael Brown, he brought up something to me this week about we really need to be watching the Bund spread, as you pointed out, and it could signal actually a reversal in the euro, or maybe some headwinds for the euro if the euro does spike higher. That's something that everybody should be watching tomorrow.
Yeah. Mate, look, you can look at that BTP spread versus Bunds on TradingView. You can just set up as a room and you overlap them and you can see the correlation for yourself. I want to touch base on the US dollar, because it all comes back to this at the end of the day. If you've got euro dollar pushing 106, it's still a US dollar move. And as you rightly say, every single time, Blake, it's all about the US. It's always all about the US. It's all about Fed policy. But I want to know your view on the US dollar. Now, we both agree that the Fed meeting was hawkish. The market has looked through a lot of what they're saying and saying that, we still expect a scenario to play out that perhaps the Fed are not looking at in 2023, and perhaps they'll come more over to this market pricing, which again is really interesting in itself. But the initial reaction from the Fed meeting was to buy dollars, and then they sold. There was a big reversal coming through. I think we're both agreement that once the market heard this idea that they are open to a 25 basis point hike in the February meeting. And that will be determined by the next payrolls number, which comes out on the 7th of Jan. The next CPI number is the 13th of Jan, which is going to be an absolute blockbuster. It's going to be the 12th for you guys in the US. But for us here in Australia on the 13th of Jan, once we got those two pieces, we could get a 25 basis point, we could get a 50 basis point hike. The market at the moment is pricing 32 basis points for that meeting. So we need to see the data and that will determine that, and that may feed through into the US dollar. But the US dollar's on a bit of a downtrend at the moment, right, Blake? The question for you now is whether there's more hawkish Fed that the market's not necessarily buying. Do we buy dollars going into year end? How are you positioned here?
Yeah, you're gonna make me give away the rest of the show, Chris. I don't want to.
Just give us a little sneak peek, mate.
I'm gonna pass. Oh,
it's going to make a boring question.
Jokes aside. I'm actually looking to buy dollars on dips here. And I know that might not be a surprise to a lot of people, but there's a reason for it technically. And also I believe that the market is going to be faced with an idea after we're done with this week that we do have central banks that are tightening globally, and they're going to continue to do so, and that will eventually weigh on the markets, and it's going to feed into the dollar getting a near-term bounce. I am a dollar bear longer term, but I think you can play it both ways, and I am looking to buy a dollar dip on weakness following tomorrow. So I'm going to get a little bit more technical with that view as we go through this show.
Does that mean by extension then, if you're buying pullbacks in the US dollar, then you're looking to fade rallies in the S&P and the Nasdaq? Are you doing it by that extension?
I do. I think so, and I think that the S&P, the move above 4,100 earlier this week, is really a warning sign to bulls. But I think about FOMC, Chris. You got me thinking about FOMC the last few weeks, and that's an extremely strong power that you have to be cognizant of as we go into year end.
Yeah, so, right. Well, I like the fact that I can put words into your head and make you think about them. It's the telepathy that comes through. But no, I think it's an interesting one. I think there's going to be lots of weird and wonderful things that happen into the end of the year. If we do get that FOMC rally that it's in your head, then I think the dollar sells off, and that will continue to see the Aussie dollar push higher and the Kiwi dollar push higher, CAD looking good, all of those factors. We can't rule that out. Recession is and growth is a big consideration for next year. Lower inflation, growth concerns take over, and I think what happens at the start of the year, you get the new reset. It's an economic calendar year. Active managers are reset. They've done what they need to do. They're starting from zero. That's when things become real, and I think that's when we could start really putting on that recession trade, which I think you're already seeing in gold and silver and rates and bits and pieces. So an interesting one.
Well, then, that brings us to our last topic is in the markets. We are getting some mixed signals, but Chris, you put something in my head. Don't tempt me. I'll sing the Smurf song, and then you'll be thinking about little blue people for like the next week. So don't start with me.
All right, fair enough. Thank you.
I'll follow you all day long. Anyway, Joe, no, I want to talk about the mixed signals that we got in the markets today, and you got equities, like the S&P was marginally lower. The breakdown in the US dollar, as you pointed out, it does seem real. I mean, you got the move higher in the Kiwi. You've got the sterling, trading above 123.50, which is really key support. Yeah. You got the euro above 106. You got the Aussie dollar that's looking like it wants to tag the 200-day moving average and maybe higher. Dollar yen's moving down towards the 200-day moving average. So the dollar breakdown seems real, but gold, it's stalling. We can't break above 1,800. We're really struggling to get above 1,800. And that's as silver continues to surge higher. Stocks, again, we're struggling around the 4,100 level. It's a big channel resistance that we've talked about in nauseum for this whole entire year about that big channel. Yeah. I know, seriously. But the bond markets seem kind of indecisive here, like on the cusp of a reversal, but then we're stalling at key resistance. So yields are kind of stuck, and the VIX is sliding, which suggests that stocks should be going up. But then I just gave you a bunch of other reasons why it's a little mixed. So how are you navigating through this noise? Because I found it a little bit of a struggle today. How about yourself?
Well, I think when you get a Fed meeting, how often do we see it, Blake, that things go crazy on that first day, and obviously the outcome is known now. Position changes. You have people positioned for an outcome, they change it around. Liquidity is an issue. The next day, so the session ahead is where you get the real move. People are actually calmer heads of prevail. That's where we're going to get a lot of clarity. The other thing that we've got to consider, and this affects things like the put call ratio and the VIX and implied vol in the market and some of the hedging flows that dealers have, is that we've got triple witching coming through tomorrow. SPY options, you've got index options, cash options, and they're talking about something like $3.7 trillion worth of notional, which is going to be expiring. And obviously dealers are doing various factors. They're managing their deltas and the gamma effectively as around that. So there's a lot of crazy shit going on around that, and that needs to be taken into consideration. But I think that the implied vol in the market has been driven that. But I think these breakouts in some of the dollar pairs, they need to be looked at. We know a lot of breakouts fail. People who like to trade breakouts are generally trend followers and momentum traders, and you sort of kick up. But let's not rule this out. You've got those setups in Aussie dollar Swiss to the downside, as I talked about. Silver looks great. Love the silver gold ratio as a long short strategy in itself. But I think we need to get through this week. As he's talked about ECB and various factors, but we've got that options expiry, and I think once we get through that, if the market is ripping, then go for it, because I think that will flow through to the end of the year as FOMO kicks in. So I think the new year will be the reset. But I think if we get through this week and the market hasn't de-risked, then I think it's on for the rest of the year. I think that chance of going higher is very high. So that's pretty good. Anyway, let's go to that's the setup. Let's have a look at some of the charts on Mind. We just talked about silver there, Blake, and I've coined this one a rich man and woman's gold as well. And you can see this is absolutely ripping to the upside at the moment. We've got that break of the horizontal resistance, also what is now support, and it's just been on a one-way tear. I love the moving average studies. I've got a 3 and 8 day exponential moving average. They're just telling me as a mechanical stop, just stay in the trade for now until we do see that crossing over. Obviously, when that does roll over, you surrender a little bit of that profits by using something like that. But by having a fast moving average system, then you don't wait too long. You can see that it's hugging the Bollinger Band. You've got those, the nice continuous push to higher highs that are coming through. The rate of change is still positive, although it's coming down a little bit at the moment. Silver is outperforming gold, so we preferred buying silver and shorting gold as a pairs trade. Where does this go, Blake? $25? Can we see it there?
Well, $25 is the 78% retracement of that entire chart. So it's a key fib level that comes in right at $25. One of the technical issues is we are actually attacking those previous lows that you can see on the far left. Those lows come in March, and we're there right now. And relative strength, which you don't have on this chart, at least not that I can see, it is divergent at these levels. That does concern me a bit. But when you have the silver gold ratio moving higher, as you pointed out, which I think is a great pairs trade, typically that's bullish for precious metals as a whole. So I think that buying silver on dips makes a lot of sense to me. Not sure I'd be buying it up here, me personally, but I could see $25 eventually making our way up there. But I think a lot of it's going to have to do with the FX market, right? Because when at the end of the day, silver and gold is the inverted trade of the dollar.
So this is an interesting point, right? So when you've got a trend like this that's taking place, if you're not in it already, you're looking for, do I buy pullbacks and follow this? But this is the interesting thing, I think a lot of people use RSIs, MACDs incorrectly. So if you're looking at this right now, you would bring this up and just say, the first thing I'm looking at the RSI is not that it's overbought, and we can see that in the chart, that you could obviously look at a chart like this and say that the RSI is going to be pretty high. It's just purely, are we seeing red flags from a divergence perspective? Is that all you're going to be looking for it?
That's what I do, because when something's hitting a new high, but it's hitting a new high on less relative strength, that tells me that this push higher, it's harder to trust. So I might go with it, but that's one of those red flags that kind of sticks out for me. So anyway, that's it. But look, silver's been a great play. And
buying silver on
speaking
dips.
Of precious metals, what's that?
Buying silver on dips. I think that's the play.
Yeah, I think that is the play too. I agree with you. Speaking of precious metals, let's take a look at the DOCTA and let's take a look at copper. And you know what? This might be, Chris, more of a China play.
Absolutely.
It really is. But here's the other thing. is the China play over yet? I mean, has everybody already priced in the fact that China is reopening slowly? And I know we had these talks over the last several weeks where we need to think about it from a slow rolling process. But, I look at copper and, a move in copper above the 200-day moving average, that's going to be a pretty bullish move in my view. And I like the setup. I like the fact that we're consolidating just below that 200-day moving average and those previous highs. So, for me, if copper breaks out, I think this is going to be a severe breakout. And this is one that if risk is moving higher and we get past this week, and you talked about, hey, at the end of this week, we'll know if it's game on or not. I think one of the plays there is playing copper to the upside. So what are your thoughts with copper here?
Well, I think there's other factors in play, but I agree. It is the China play. I mean, when the Fed come out and downgrade their GDP forecast for this year to 50 basis points, and we know they're often wrong, and it could be much lower. We could be talking about a recession there, which is something that the rates market is telling us in the US. You don't get 58 basis points of cuts being priced in if we're going to get good growth coming through, right? And but I think the copper market's looking more at China reopening, and a lot of good news is probably priced in. But the other thing is the number of sell-side banks who are putting out bullish notes on copper now. Why? Because of the structural deficit that we're going to see next year. That's what they're anticipating. So, you can look at aluminium, or aluminum as you would call it, and all these other sort of industrial metals, and look at the supply-demand equation from there. But they're saying in 2023, the demand for copper is going to pick up substantially to the point where we're going to run a deficit. And I think that's why people are quite warming to the copper situation. But I think, a break of that 200-day moving, a break of that resistance, the red resistance level there, you can see. I mean, it's telling you a pretty clear story about what's going on. You can have a recession in the US, you can have a recession in Europe and UK and all these other factors. You can talk about low growth in China. But if price is moving up, it's telling you a story, and it's not just about finding out the why. The market likes the story, and that's all that matters for short-term traders.
Yep.
Anyway, I wanted to bring up the chart of the US 500 because we talked a little bit about what's happening. It's a chart that I've been looking at and we've been looking at quite a lot. Look at that candle that we saw coming through on that US CPI number. I've got that red arrow, but it's just to the right of that one on the CPI number. An absolute behemoth of a reversal coming through that came through in the market there. We obviously saw a big spike up on the CPI number. The market came back down. You haven't really seen too much of a reaction there from the Fed meeting in terms of the price action, certainly compared to the CPI number. But we haven't really fallen. We found really good support into 39.29, which is that series of lows that we've been seeing. The market just didn't want to break through that. That was a level that we were going to look at shorts much more aggressively if we saw a breakthrough there. But again, it doesn't want to break through the 200-day moving average with any kind of conviction. It doesn't want to break this downtrend. We're kind of stuck between the downtrend resistance and this 39.29 support. And I think one of those is going to give way pretty soon. Which way is it, Blake?
Well, first of all, I have to commend you for you pointing out that the market was pricing in a bigger move in CPI this week than the Fed. We got exactly that. So you told us that last week, Chris. So great job. Now, this is the false breakout that I was showing you or talking to you about, is the one that was above 4,100. I do believe that, as you pointed out, 39.25. I'm actually looking at 3,900, the figure. So 3,900 to 4,100, above or below, that's the breakout point for me. And look, if we break above 4,100 and by the end of the week, we're trading up towards the highs of this range, that suggests that we might get that Santa Claus rally. I know you love the Santa Claus rally, Chris. I know it's something you think about every single day.
Before the Easter Bunny seasonal rally.
Correct. But if you get fund managers chasing the market higher above 4,100, you have to respect it. So I think we have a 200-point range, and that 200-point range is going to give way here within the coming week or two. So
we could easily just chop around, though, couldn't we? I mean, I know we've got, as I say, option OPEX coming through on Friday. But, it does seem that there's pretty clear supply coming above 4,100. It looks like the market's well supported into 3,900. So, why can't we just trade a range of 4,100, 3,900 until the end of the year, and you just trade that range? I mean, we could easily see that, right?
Are you really going to ruin my evening, Chris? You're really going to ruin my evening. Hey, but I have to say that OPEX options expiration sure does have us pegged at 4,000. That's for sure. That's where we're trading right at this moment.
That's where all the open interest is.
Let's take a look at my next setup. Now, this is the Euro Kiwi. The Euro looks good on crosses, Chris. And one of the crosses that I think it looks really constructive on is the Euro Kiwi here. The Kiwi has had a hell of a run. It's had a hell of a run against most currencies. If you look at the Aussie New Zealand, you look at you look at the pound Kiwi, you look at the Euro New Zealand. Look, we've been in a descending wedge for like literally all of fall going into winter. And I love descending wedges because they are setting up for reversals. It's a classic and one of my favorite textbook type of reversals. So a move above 166, which would be pretty much today's highs in North American trade. You get above that, you've got a bullish reversal. I think this comes through the ECB. Like I said, I think the ECB is going to be a little bit more hawkish. And if we do get a little bit of a reversal on stocks, then the Euro New Zealand tends to perform a little bit better, as those higher beta currencies like the Kiwi dollar get hit. Euro New Zealand, what do you think, Chris?
Yeah, I think going to tonight's ECB, I think for the euro to rally, we do need to see that BTP Bund spread staying fairly contained. If we do see a widening, then I think we could come under a bit of pressure. But I like this. I mean, the market, it's been consolidating. The propensity to push this one down seems to be absorbed. And it feels like a bit of a coiled spring, right, ready to go. So again, with any kind of setup like this, where you're studying the price action and the battle between the bulls and the bears, you wait for the market to complete. Otherwise, it's a very aggressive setup playing through. So, I would wait for this to reveal itself and push you into a trade, which means breaking that downtrend playing through. But I guess in an environment of risk off, obviously favours being short the Kiwi, but the funding currencies, the euro, the yen and the Swissy tend to do pretty well in that situation. So you could probably do with a slight range trading market, if it's not a slightly downward market coming in the S&P as well. But I think if this, regardless of all that, if this breaks that downtrend and it starts to reveal itself a little bit, then I'd be looking at the euro from the long side. But again, look at that BTP spread relative to bunds. If that widens out substantially, I think that's going to be a big risk to any kind of people who are holding European longs or euro long, so that's something to watch out for. Anyway, let's go to play of the day. Let's see what's on the mind there. Last week, Blake, I looked at long China, short US. That trade really hasn't done a lot. I think we sort of caught that one at the top. It hasn't really lost any money, but it's sort of trading sideways. I still like on a pairs trade, long silver, short gold. But I want to bring up dollar Swiss today. Why? We've talked about all these different dollar pairs which are breaking out, and one of the ones we really like for 2023 is the Swiss franc. In an environment of lower growth, which I guess is going to be one of the core thematics of 2023, the Swiss franc generally does really well. It has had poor episodes for this year as a safe haven because obviously bond yields have been going up. But in an environment of lower growth, you want to go into those current account surpluses. And there's nowhere really in G10 that's got a bigger current account surplus than Switzerland. We like that. It's about 9% of GDP. I like this trade now. It's doing everything right to the downside. If you want to be short dollars, I think for me, being long the Swissy is a place to go in an environment of lower growth. It's trending lower. I think I want to sell this into slight strength. As we talked about there could be a bit of a dollar move. If we do, we want to capture that into what is obviously the flow of capital's going down. So I'm looking around sort of just into just below 93 as kind of the level to look to sell into. But I really like the story for Switzerland in 2023. I love that hedge against lower growth. I think that's the place to be, along with the Japanese yen. And I think if we're trading this, we've got the technicals working as well. A little bit overcooked. Just looking to sell a bit of strength into this one at the moment.
I like it, Chris. I like it if you're selling dollars, but look, my play of the day is going to be the dollar, and I'll tell you how I'm going to express this move. But before I do, I do want to mention Euro Mexican peso. It's been grinding higher all week this week. So it has been. We got
Mexican central bank meeting this week, haven't we? We've 50 basis points.
We do have Mexico as well. So I mean, it's the central bank bonanza once again. Bonanza. But the dollar index. This is the trick, Chris. I am looking for a little bit more weakness. I'm looking for the euro to trade up to 107.75, maybe 108, and then I'm going to express my dollar bullishness or bounciness through the euro by shorting the euro up around the 108 level, because the dollar index, if you don't notice here, it's a 618 retrace or 161% extension of the September spike move higher into new highs, and then it's come down to the 161% golden fib level. That blue line that you see there, that's the COVID March 2020 spike high. Previous highs. So we'd just be simply retesting those highs, previous resistance, current support, playing the dollar for a bounce, That's how I'm going to do it.
Like it. Well, so I'm looking to sell rallies in the dollar. You're looking to buy dips in the dollar. It's an interesting conundrum. But do you know what? For the viewers out there who've stuck around, thank you very much. We really appreciate. You're not going to be able to hear us until the new year because we're going to take an extended break. I'm going on holiday with the family back to the motherland in the UK. Blake, I hope you have a wonderful Christmas as well and festive season. And if you guys at home, if you choose to celebrate the festive season, we really appreciate you guys sticking around with us all the year and making it a fabulous show. And we really hope you've enjoyed it as well. So we'll see you back more of next year for more of the trade-off. Thank you.